Hey everyone, Disney reported fourth quarter and fiscal year 2023 results on November 8th that really impressed stock market investors. The stock was up as much as 5% on the day following the earnings announcement. In this video, I'm going to review Disney's latest quarterly earnings results, and I'm going to update my buy recommendation for Disney stock. Coming into the quarter, I had Disney stock rated as a buy, so you're going to want to tune in to see if I'm changing that recommendation or if I'm even upgrading that recommendation from a buy to on my list of one of my top stocks to buy. So even though it was just a buy, it still has room to be upgraded further in my ranking criteria.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So let's jump right in, starting with revenue, which grew 5% in the quarter and 7% in the year. Solid growth for Disney overall on the top line. Diluted earnings per share for the quarter increased to 82 cents. That was up from 30 cents in the same quarter the prior year. This boost in earnings per share, this more than doubling, this is not something that's sustainable for the long run. This is just something that Disney is achieving right now because it's recovering from the lows from the pandemic. Remember, the business was devastated from the pandemic, and so it's still recovering, which I'll show you some statistics about that. It's still recovering from those devastations from the pandemic. Still not fully recovered. Disney Plus, a key thing investors look at, added nearly 7 million core subscribers in the fourth quarter. We'll look more into the Disney Plus segment a little bit later in the video. Overall, an impressive quarter from Disney's streaming segment. Disney says they continue to expect that their combined streaming businesses will reach profitability by the fourth quarter of fiscal year 2024. This is something I've liked since Bob Iger has returned as CEO. There's been a shift in focus from just going after subscriber growth to now going after profitable growth. They're not just going after members just for the sake of going after members so that they can report millions of new subscribers added. They're not doing that. They're going after members that are going to be paying enough money to Disney to make them profitable. So I like that shift in focus from profitable growth instead of just going after customers just for the sake of reporting that we've added millions of new customers. The segment in experiences, operating income jumped by over 30% versus the prior year quarter. Disney's benefiting from consumers unleashing pent-up demand for away-from-home experiences. Disney's in an excellent position to benefit from that with its various away-from-home experiences to offer customers. We'll look more into that a little bit later in the video as well. Also, Disney has been on an aggressive cost-cutting campaign, and they increased that goal from the previous $5.5 billion target in cost savings to $7.5 billion in cost savings. This should be music to investors' ears. Investors like when companies undertake cost-cutting campaigns, and this is no different. And due to these cost-cutting campaigns and the rebound in the business, Disney expects to continue to grow free cash flow in 2024, significantly higher than it was in 2023 and approaching levels last seen since before the pandemic. Remember, the business was devastated because of the pandemic. It's good to hear the CEO saying that we're going to get back to those levels closer in 2024. So let's look at a breakdown of the company's revenue and expenses and then free cash flow for the quarter and the year. You see here a breakdown, revenue increasing 5% from the previous quarter, which ended September 30th to 21.2 billion. That boosted cash flow from operations to 4.8 billion, up from 2.5 billion, a 90% increase in cash flow from operations for Disney in the most recent quarter. And then free cash flow almost tripling to 3.4 billion, up from 1.376 billion in the same quarter the prior year. Similar story when you're looking at the full year numbers. Cash flow from operations jumping by 64% to 9.866 billion, and free cash flow jumping by almost 5x to 4.9 billion. And this is what I've been advising investors to pay more attention to with Disney is cash flow from operations and free cash flow and operating income, and trying to look past these disrupted figures coming out of the company because of the mess that it's been involved in over the last 3 to 4 years, with a major acquisition, the pandemic disrupting the theme park business, and then the switch from legacy cable TV channels to the streaming segment. There's been a lot of disruption, changes in accounting policies, changes in the valuation of goodwill, the valuation of assets, and thereby creating a lot of these non-cash expenses, these restructuring charges, these write-downs that are not cash expenses. And so while Disney might take a charge off on those, they're not cash expense. So they don't decrease the company's cash flow. And so looking at the company's cash flow from operations, you get a better view at what's going on with the company, what kind of money is coming in, what kind of money is going out. And you kind of look past those restructuring, those reclassifying, changing this number from accounting it as a streaming revenue versus a revenue coming from a cable TV channel, and all of those different various restructurings that's been happening at Disney. Okay, so one of the bigger risks that I've been following with Disney is that transition that I talked about from consumers switching their consumption to streaming in favor of consuming their content previously through a subscription of a cable bundle or a satellite TV bundle. And remember, Disney generates a significant amount of revenue and profit from that segment, from the cable and linear networks. And the transition to streaming is not going to be smooth and has not been smooth for Disney. And so I've been paying close attention to this to see if management can conduct that transition in an orderly fashion, in a way that doesn't take away too much of that cash cow, take away too much from that cash flow from the linear segment, because as I'm showing you here, that segment is significantly profitable while switching it over to linear streaming. And so what I have here, linear networks revenue highlighted in the quarter ended September, revenue fell 9%. But thankfully, operating income stayed flat at $805 million. What Disney has been doing as it's been losing customers in the cable and satellite linear network segment is it's raising prices to offset some of those declines, figuring that customers are going to leave anyway. Let's try and get higher prices from those customers that have chosen to stick around and thereby make the business more profitable in this transition. But you'll also see that the direct-to-consumer segment grew revenue by 12% to $5 billion, but it lost $420 million in operating income in the segment. That improved, however, from the $1.4 billion loss in the same quarter the prior year. Disney's making progress in reducing these losses on the bottom line, and as I highlighted earlier, management expects this segment to be profitable by the fourth quarter of fiscal year 2024. So in 4 quarters, this segment is expected to be profitable. And you'll see this is the segment that's generating the biggest losses for Disney right now as it's transitioning over to the streaming consumption model. All right, I mentioned earlier that we'll take a look at Disney's streaming segment, and here is that metric that I highlighted earlier. Disney Plus core subscribers increasing by 7% from the previous quarter, from July 1st to September 30th, adding nearly 7 million subscribers to 112.6 million. Disney Plus Hotstar lost roughly 3 million subscribers, from 40.4 million to 37.6 million, but I'll highlight in a little while in the next slide why that's not that important compared to the addition of Disney Plus core subscribers. So stay tuned and let's go look at that. So Disney Plus core subscribers that we talked about in the previous slide, they generate an average revenue per user of $6.70 for Disney. That was up 2% from the previous quarter. But look at Disney Plus Hotstar subscribers, they only generate 70 cents for Disney, and that was up 19% from the previous quarter, as Disney has just boosted prices and said, all right, you Disney Plus Hotstar subscribers are already getting a significantly lower price. We're going to start boosting the price. We don't care if you choose to cancel because you're getting such a good deal. we need to raise the prices to make you pay a amount that is profitable for us as a company. So they don't mind losing a couple of million of these subscribers that are worth nearly 1/10 of Disney Plus core subscribers. And Disney added 7 million of the core subscribers and only lost 2.5 to 3 million of the Hotstar subscribers, which generate significantly lower revenue than the core subscribers. One more thing with Disney Plus, they've announced price increases that are going to go into effect any month now. I believe it's this month or next month. They're going to raise prices again on Disney Plus. They've raised prices significantly since the introductory level used to be $5.99 a month or $4.99 a month. Now it's upwards of $9.99 a month for the ad-free version, but you can get an ad-supported version at a lower price. So Disney is really trying to push consumers into the ad-supported version because they feel they can get more subscribers that way, and the average revenue per user is likely to be higher also because they generate more ad revenue from those ad-supported subscribers. One more thing I want to add, one final thing I'll add with this transition from the cable consumption model to the streaming consumption model. Investors have been fearful of this shift because the legacy linear network model had been so profitable for all of the studios. They've been doing this for decades now, and there's been an equilibrium that was reached, and investors felt comfortable with this profitable model. And the switch now, there's a lot of uncertainty associated with it. What's going to be the equilibrium profit margin for the streaming companies? That remains to be seen, right? Several of the streaming companies besides Netflix, they're all losing money. Netflix is really the only one that's making profits from its streaming segment. And so with the rest of these now coming in since 2019, 2020, it's the question mark, what's the equilibrium profit margin? Well, you can look at Netflix, which is upwards of 20% operating profit margin, a very healthy operating profit margin that certainly compares closely with what the studios were earning before this transition started. So an operating profit margin in the mid 20s would be excellent for all of these streaming companies at equilibrium once they reach that scale. When they've finished transitioning over to that, that would be incredible. Remember, the switch from legacy to streaming is going to create increased demand for content, increased streaming overall. People are going to be watching a lot more content than they were before the switch. So they're going to consume a lot more content from all of these studios, Disney included. So while up until this point, the investor concern has been with the shift in the consumption model, changing that profitability dynamic, there's been little talk about the surge in consumption that's happening because now it's more convenient. Now you can take your Disney subscription anywhere you go. It's on your phone, it's on your iPad, it's on your laptop, so you can watch it anywhere. And so that's created a surge in consumption. And it's not just with Disney, it's with all the studios, right? And so now you can watch it anywhere you go. That's going to create an increase in consumption. And an increase in consumption is usually a good thing for the industry. Now, I will admit it's going to be risky, it's going to be choppy, and I've been saying that for several years now as this transition is going on. But longer term, I'm excited about the fact that there's going to be an increased amount of consumption, and the increased amount of consumption is going to lead to an increased amount of revenue and an increased amount of profitability for the industry overall, Disney included. So the last segment I'll talk about in this video before answering the change in my recommendation is the experiences segment. This is where Disney reports its parks and experiences, its hotels, its cruise ships, all of that are in here. And you can see that this segment revenue jumped by 13% in the quarter to 8.16 billion, and operating income jumped by 31% to 1.759 billion. This profitability is even better if you exclude the consumer products segment, the merchandise segment. It looks even better profitability wise. Still, even though this segment has been booming for the last, I want to say, year and a half, ever since the economic reopening gained momentum, it's still not back to full strength, right? The profitability is higher than ever, but it's still not back to full strength. Let me show you this slide here. So here I have pulled up the number of people visiting theme parks worldwide, and it's not just Disney's theme park, although many of these theme parks are Disney. There are some others in here as well. And you can see 2019 to 2022, even though 2022 is a big jump from 2021 and 2020, it's still below those levels in 2019. The most visited theme park in the world, the Magic Kingdom, Walt Disney World USA, had 17 million visitors in 2022. That was still down by more than almost 4 million from the 21 million in 2019. And it's a similar story across the board. If you look at theme park visitation worldwide, it's still below where it was 2019, even though it's much higher than 2021. And even though 2023 still increased from 2022, it's still below 2019 levels when the annual figures come out. So there's still room for this trend to continue, for this pent-up demand from consumers to visit theme parks. There's still room for it to go. It's still not even back to 2019 levels. So it can go further. The reason it's more profitable than ever has been because of massive price increases across the board. Disney and others have been boosting prices, and so that's creating a surge in profitability for these segments, even though the number of visitors are still not back to where they were. So this is another reason to be bullish on Disney stock. All right, so I mentioned that the stock price jumped following the earnings results. Still, Disney stock is not prohibitively expensive, trading at a forward price to earnings of 16.25. And so based on what I saw from Disney's latest earnings results, the upgrade in cash flow prospects, the upgrade in cost savings by $2 billion, the increase in millions of the Disney Plus subscribers segment, and the bullish outlook for the Disney streaming segment overall. I'm upgrading my Disney stock recommendation. I'm upgrading Disney stock from just a buy, and I'm putting it in my list of top stocks to buy right now. So Disney stock has earned an upgrade from me because of its latest quarterly results. But before I let you go, if you gained any value from this video, please subscribe to the channel. It'll really help me make more videos just like this one. Thank you so much for watching, and thank you for subscribing if you've already done so.